Australia's financial system is built on trust, regulation, and opportunity, but for most people, loan acquisition feels like a gate guarded by paperwork and percentages. It's not that the system is impossible, it's that it rewards preparation over intention. If you understand how Australian lenders think, what they measure, and how they price risk, you can step through that gate with confidence instead of anxiety. The truth is, in Australia, loans are not one size fits all. Whether you're applying for a personal loan, a mortgage, or business financing, the process revolves around one central question: how risky are you to lend to? Every part of your financial life, your income, your spending, your credit history, even your digital footprint helps lenders answer that question. At the heart of every decision is your credit file. And like some countries where you can disappear into financial obscurity, Australia's credit reporting system is highly integrated and constantly updated. Every repayment, every credit card, every utility bill, they all form a timeline of how responsible you've been. Agencies like Equifax, Experian, and Allian keep detailed records that lenders analyze before making any commitment. A strong credit file tells lenders you're disciplined. It shows that when you borrow, you repay. And that's exactly what gets you the best rates. A weak file doesn't mean you're doomed, but it does mean you'll have to compensate with income stability, lower borrowing amounts, or additional collateral. If you're applying for a personal loan, lenders want to see that your income comfortably exceeds your expenses. They'll often check your bank statements to verify cash flow, not just to see if you can afford the loan, but to understand how you manage your money. Overspending, gambling transactions, or frequent overdrafts can raise red flags even if your income looks healthy on paper. This is where discipline and transparency pay off. When it comes to home loans, or what most call mortgages, Australia's lending process is detailed but predictable. Lenders will assess your borrowing capacity using your income, existing debts, and living expenses. Most aim for a serviceability ratio that ensures you can handle repayments even if interest rates rise by a few percent. The Reserve Bank of Australia's interest rate decisions have a direct impact on borrowing costs, so timing matters. Applying when rates are low and markets are stable can save you tens of thousands over the life of your loan. Many first-time buyers make the mistake of fixating on interest rates alone. But the real art of borrowing in Australia lies in understanding loan structure. Fixed-rate loans provide certainty but limit flexibility. Variable loans can fluctuate but often allow extra repayments and redraws, tools that can dramatically reduce total interest over time. Smart borrowers mix both, locking part of the loan for stability while keeping the other portion flexible for strategic repayments. For business loans, Australian lenders look beyond credit and income. They want to see vision, structure, and data. A clear business plan, financial statements, and a solid cash flow forecast can transform your application from risky to reliable. If your business is new or still growing, government-backed programs like the SME Recovery Loan Scheme or state-based grants can provide leverage and credibility. These programs often act as a bridge between early-stage growth and traditional bank lending. One thing that sets Australia apart is its regulatory transparency. The Australian Securities and Investments Commission (ASIC) and the Australian Prudential Regulation Authority (APRA) ensure lenders maintain ethical standards. That means borrowers are protected from hidden traps, but it also means lenders must strictly evaluate every detail before approving funds. This creates a system where preparation beats luck every time. Now, let's talk about a hidden advantage many Australians overlook: credit unions and non-bank lenders. Unlike the Big Four Commonwealth Bank, Westpac, NAB, and ANZ credit unions and fintech lenders often provide faster approvals and more flexible eligibility criteria. They focus on real-world indicators of responsibility rather than rigid score thresholds. For freelancers, gig workers, or small business owners, these alternative lenders can be game changers. However, that convenience comes with responsibility. Always compare the comparison rate, not just the advertised interest rate. The comparison rate includes all fees and charges, giving you a true picture of what you'll pay. A loan that looks cheap on paper can be costly once you factor in establishment fees, account-keeping costs, or early repayment penalties. Timing, as always, is crucial. Apply for loans when your credit file is clean, meaning no recent hard inquiries or late payments in the past 3 months. Lenders interpret frequent applications as desperation, not ambition. So space them out, build a consistent savings record, and apply strategically. Let's talk about debt consolidation, a growing trend among Australian borrowers. Instead of juggling multiple high-interest debts like credit cards or store finance, consolidating into one structured loan with a lower rate simplifies management and reduces stress. But consolidation only works when followed by discipline. If you clear your credit cards but then max them out again, you've created a deeper trap. True consolidation means resetting habits, not just accounts. Australia's loan culture is evolving fast. Fintech startups are introducing AI-driven lending, analyzing not only your financials but your behavior of how you spend, save, and communicate. That means your financial habits are now more visible than ever. Automation has made borrowing faster, but it has also made responsibility non-negotiable. Let's step back for a second and look at the bigger picture. Getting approved for a loan isn't about being rich, it's about being consistent. Lenders don't need perfection. They need predictability. Regular income, clean credit, realistic borrowing, these are the 3 pillars that carry almost every successful application. But the real power comes after approval. What you do with the loan determines whether it becomes a burden or a blessing. Borrowing to invest in assets or business, education, property creates growth. Borrowing to consume or impress creates dependency. Every dollar you borrow should serve a purpose, not fill a void. There's also a psychological shift that happens when you move from borrower to strategist. You stop asking, will they approve me? And start asking, does this loan serve my long-term goals? That's where financial maturity begins, not at the application, but at the decision to align debt with direction. Here's something even experienced borrowers forget. Pre-approval isn't guaranteed approval. It's an indication that you meet criteria based on preliminary checks. Once lenders verify details and valuations, the final approval may differ. So always keep your financial position stable between pre-approval and settlement to avoid large purchases, new credit cards, or job changes during that period. Australia's credit culture rewards subtlety, quiet, steady behavior that builds credibility over time. A missed payment or impulsive financial move can echo across your file for years, but equally, positive changes compound just as powerfully. If you stay disciplined, review your credit file regularly, and manage your accounts with precision, you'll find the doors that once seemed locked begin to open effortlessly. At its core, loan acquisition in Australia is about alignment between your goals, your habits, and your financial narrative. The system isn't against you, it's designed to test your readiness. And once you pass that test, the opportunities are limitless. Remember, borrowing isn't just about getting money. It's about building momentum. Every responsible loan adds to your financial story, the story that lenders, investors, and future partners will read when you least expect it. Make sure it's a story of control, not chaos. And, as always, a quick disclaimer, this video is for educational purposes only. Loan terms and eligibility vary across institutions, and your personal circumstances matter. Before taking on new debt, consult a licensed financial advisor or credit specialist. Borrow wisely, plan intentionally, and let every loan you take move you one step closer to financial independence, not further from it.